All right, welcome to 2025, week number 12 of the Build Weekly Roundup. Glad to have everybody back here with us this week. We've got a lot of interesting kind of news going on, especially in this post-FOMC these next couple of days, as well as some interesting updates coming out of the EU. So I think we're going to have an interesting episode for us to dive into this week. Um, we did want to remind everybody, so some of you might have noticed that we're live streaming on our at Build Markets account. So we used to stream directly from each of ours, decided we should centralize that a little bit just to make it easier to find the content. So not only will you find all of our future live streams coming from that Build Markets account, but you'll also see clips that we've kind of created from these live streams, as well as any interesting content that we'll retweet and post from Build Markets. So kind of scrolling through that, you'll see some posts from Matt as well as other folks related to Build. So with that said, let's hop right into it. So the first thing that we probably want to talk about this week is going to be the recent FOMC meeting. And so to start us off here, we know one of those big key items is going to be the spending bill deal that was signed by Trump, which means that's no longer a concern in the near term. But coming out of that, we went right into the FOMC meeting yesterday, which I'm going to then turn over to Matt here. But putting up on the screen here, we have the change or the notes meeting over meeting. And so the Wall Street Journal does a good job of creating this tool that shows you essentially what the changes were from the prior meeting minutes. So Matt, I'll let you kind of talk a little bit about what do you see here in the text that kind of jumps out to you, and coming out of that meeting, kind of where do you see the market going?
Yeah, so we kicked off the week actually on Saturday to roll the tape back a little bit with the agreement from the Senate to send the continuing resolution bill to Trump's desk, which he signed on Saturday, which averts a government shutdown potentially, but essentially just pushes the debt ceiling debate 6 months into the future. So that timeline for that to pick back up again is probably August, September. But we will, because of that, we took the negotiation off the table for some sort of debt ceiling battle, some federal spending freeze. So that's a positive for the overall economic setup, going into this. That the government spigot will not be turned off to the full complete shut. Um, so that was how we started this process, which changed a lot on the fixed income landscape. We were all holding our breath, waiting for the FOMC meeting on Wednesday, which is where we got into policy. Now we knew that rate cuts were not coming. We'll get into the calendar sequence of how this looks a lot like the 2019 cycle. But what we got that wasn't fully expected by everybody was the slowdown in QT. So the big announcement, if you want to go to the Wall Street Journal slide, is that the blurb. There's two of them I want to mention. The one in the green. So beginning in April, the Treasury securities balance sheet tightening runoff will decrease from $25 billion a month to $5 billion a month. So once I show you the slope of the lines on the next slide, this is really just kind of I won't say soft landing, but a very smooth long-term slowdown that began last June when the FOMC announced the first step in the policy easing cycle, slow down from $60 billion a month and run off to 25. Now we're down to 5. That slope at 5 is basically, it's basically zero. It's still just a trickle of Treasury runoff that is now going to have to be financed by private markets and financial institutions and other sovereign buyers versus the Fed SOMA account adding to Treasury holdings. Now, the agency debt and agency mortgage securities, they stay $35 billion in runoff. So all of the buying and support that the Fed did through its SOMA facilities, buying Fannie and Freddie originations, all of that, from the post-COVID surge, that remains. So the kind of signal here is the FOMC is choosing to provide more support under the treasuries. Those next layers up, whether it's agency debt, other quasi-governmental institutions, or its support of the housing markets and mortgage rates for people's new borrowings. That's, the Fed is saying we need the private markets to support that. So they're really giving a signal here on they're going to support the Treasury. They wanted to get through this, but as part of their balance sheet management program, it's going to be shifted towards, the Treasury market specifically is the key here. And then on the bottom, the voting. You notice the one vote against this is Christopher J. Waller. I want to say he's a professor at Notre Dame, a former professor. He's kind of Jay Powell's right-hand man at the Fed. If you kind of divide the Fed up into political or somewhat political factions, Waller would sit towards Powell's camp, if you want to consider him more so on the hawkish side or conservative side of the Fed. So it is notable that there was one dissent here, and Waller was the only standout on the voting members. So that was the big takeaway. The market, the immediate reaction was bullish. So there was a bid on bonds, bid on equities. Dollar tanked. Dollar got hit on the intraday chart right away. So that was the key takeaway. But the next thing I think we should go into is the comparison of the easing cycle to 2019 as we're on the way down. So we've got the last two cycles here going back to 2015. The top chart is the Fed's holdings of treasuries on balance sheet, and the bottom chart is the Fed funds rate. So top is balance sheet policy, which is the QE versus QT. The bottom is monetary policy conducted through the interest rate channel. So the thing I wanted to call out here, if you notice the channel into 2019, and we'll get into what was being discussed on the timelines for the meetings, they knew that the FOMC at their meetings knew they wanted to shift out of the QT regime, and they were preparing throughout early or the first half of 2019. But those things were really compressed, the balance sheet and the interest rate easing, into a really tight window. So going back in 2019 shoes, this feels like it was yesterday almost, but it's hard to believe it was now 6 years ago. What we saw was when the end of QT hit, it was basically like on a dime, and you see that really shallow trough there where QT started in late 2017. It was wrapped up by 2019. So basically 18 months of QT balance sheet reduction on the Fed's part, and then the interest rate cuts came essentially like simultaneous with the end of QT. Keep in mind, same cast of characters here. Jay Powell was the chair of the Fed under that quantitative tightening cycle. But what you saw is kind of similar to what we've seen on the rate front this time around. Once we did cut rates, it was 3 stepwise cuts, then a pause for a wait and see. It's kind of just FOMC wants to see more data come in, see what's happening in economic growth and inflation, and also financial system integrity, its other mandates, unemployment, see how everything is reacting, like the toggles and meters on its dashboard, and then kind of read and react to whatever happens next. And as we know, like in the last cycle, what happens next once we got into that wait and see was like a total doozy. It was COVID that came, and everything shuts down in March, and by then, we know what happened from there. Interest rates get cut to zero. You see it on the QE charts. We just had massive balance sheet expansion that the Fed was forced into. Now, we're essentially at that same point in this cycle of the wait and see. We're in the the easing part of the cycle, if you will. Rates want to move down. Balance sheet contraction is the QT is tapering off. And now we're just going to have to wait and see what happens here. But this is the part of the play where the exciting things can happen, just because of where the system is at and what the vulnerabilities are, and what risks things are. The financial system is open to. Doesn't mean something like COVID is happening. There's going to be massive money printing. Doesn't necessarily mean there have to be rate cuts from here, but it's very likely there will. If you look at how curves were pricing out, it looks like we're going to get 2, potentially 3 more rate cuts, and then from there it just depends. What needs to be done. Policy at this point, when they say data dependent, what that really means is they're going to be reactive. They're not necessarily in the driver's seat. They want to wait and see. They don't want to be viewed as being the cause of something, or causing some sort of problem. They want to be there in support. Is kind of the wait and see position that they're in from here. But yesterday's slowdown in QT, you saw the first one. It's highlighted on the top chart, the first little yellow star, June 2024. Last time around we only got one. It was very kind of abrupt. This time we've had 2 slowdowns, and technically we haven't shifted even to turning off the faucet, if you will, but it's been closed up enough on the QT front where it's essentially just slow drips coming out. Might as well be zero for all intents and purposes. But that's where we stand right now. I think everything's in kind of an interesting wait and see position from overall economic conditions, and then how the financial system, dollar, foreign exchange, et cetera, kind of react from here. So we're at an interesting setup for the remainder of 2025, I would say.
It's 5 times the QT that we've done this cycle than in 2017, 18, and 19, right, Matt?
Yeah, so I have the contractions, and if you zoom out on my charts, we go back to 2008 with there were multiple phases of QE that the Bernanke Fed undertook. Yellen Fed didn't even try to do any QT. The QT started when the Powell Fed era began. And the first time out of the gate, they weren't able to get that much balance sheet normalization accomplished. It was about 0.4 trillion, and that was totally dwarfed by what they were forced into doing for acquiring treasuries and other agency debt, and mortgage backed securities, mortgage pools on balance sheet. But yeah, the QT that they accomplished this cycle was about 4 to 5 times larger. But also, there was a huge wave run up. And if you kind of look at the expansion, there was the immediate so QE actually started third quarter of 2019 at a slow pace. You see that little drip up, but then it really just 1.5 trillion in a matter of weeks taken on balance sheet of the SOMA account, and then we get into the just a smooth rise for about 2 years up until the peak of about 5.75 trillion of Treasury securities on the Fed's balance sheet. Then we start normalizing. The whole point here is we've basically taken off that 2 years of coddling support after that big March and April print, and we were able to wind that down this cycle. Now the point is that big impulse you got from, you see the 2.5 million or 2.5 mil, but the mil here is thousands. That's $2.5 trillion up to 4 trillion and further. That's all we're not able to lose that weight essentially this cycle. So what goes on from here? Is it a pause? Does the Fed have to shift into QE? We're going to have to wait and see. But it looks for now this is the most balance sheet runoff that's going to be accomplished for this tightening cycle. We've got another star of the show here with
there's Remy,
my little dog Remy.
Matt's dog is always cute when he's running around the office. Well, I think, it is a live stream. Nothing, it wouldn't be truly live. We don't have a thing that Matt needs to go attend to really quick. So Matt, take a look at your messages. But in the meantime, I think, Dave, let's flip over to this next slide here. I think.
Matt, do you need to take a Remy break or?
No, just end of day accounting. I'll be right back.
Yeah.
All right.
So we'll continue with the show, and then once Matt gets back, then we can hop into some more of his deep dive slides here. But I'm over on this next slide here. Matt actually, it's funny, it just freezes Matt in his last known video position. But but Matt actually found this the historical FOMC memos related to the 2019 meeting that occurred, or 2019 meetings that occurred. So one thing to note here is that as Jerome Powell, etc., are talking during the current meetings, we don't actually have access to the direct memos that they're referencing, or the data points that they're directly looking at during these meetings. So everything that we see in the press conference afterwards, the publicized notes, etc., that go out, written notes that go out, those are all just the shadow of what you actually see from the underlying memos that they're seeing day by day. So this is actually a listing of the actual memos, January 17th, March 7th, March 8th, and they go into detail on specific items. And Matt, on this next slide, now that he's back, perfect timing, was actually able to map these against actual policy changes on a chart. So I'm going to flip over there. This is the actual mapping of these memos to rate cuts as well as to the overall Treasury position.
Yeah. So what we have, the actual meetings, it's exactly what you would think is like a board meeting. There's policy memos, there's maybe some research pieces, some decisions that need to be made at those meetings. And these are semi-public, but those details of whatever is discussed, whatever is the pressing issue, it's not going to be released for general public audiences until well after the fact. So the most recent memos that we have access to, and then eventually you'll get the transcripts as well of discussion, who said what positions were taken, what argument, why did Waller dissent this meeting, like that'll come to light, but it'll be years into the future. Like by that time, the historical track record has already been written, and we're on to the next most pressing thing. But in real time, what we get for the general public consumption is a statement, that first one we showed, which is just 3 paragraphs. It's very well crafted on what the FOMC wants the public to take away from their policy decision making. And then you'll get a policy implementation note, which tells you more specific technical details of things that might change, like just very specific levers that are being moved or toggled with. And then you'll get a 30-minute, 40-minute press conference where the chairman or chairwoman presents a prepared 10-minute remarks reading off of a script, and then does some Q&A with the press, and you get, I guess, some limited understanding of what actually happened in the meetings with the 15 board members and what they discussed. So you don't know until 5, 6, 7 years later, potentially, what actually took place. You only get a very limited shadow, as Cameron described it, for public consumption of how they would like to present what they discussed to the world for our takeaways and how they want us to react. But the most recent memos we have date to the 2019 FOMC meetings. And very handily, that's the last time we were in the similar phase of a credit cycle as we are now, where, okay, QT or balance sheet policy was coming to an end, rates were coming in on the front end, and then you have some other similarities. Now, things will differ in the particulars, but in the general sense, but kind of line up, and we're still talking about much of the same issues. So, as Cameron mentioned, I went through the memos and just highlighted. You look at the dates and you see how this lines up. This is probably what's going on, something behind the scenes. And they'll be dealing with some of the more pressing issues we're considering today, like the Trump administration, or certain things Treasury might have planned, like a Bitcoin strategic reserve, for example, like things like that. And they're thinking, all right, how is this going to work in with the overall kind of piping and plumbing of the financial system structure? What's going on with money, essentially. But just starting from January 2019 on the left, you've got, the two main memos they discussed was balance sheet normalization options and reducing the size of the balance sheet, or announcing an end to reducing the size of the balance sheet.
Sounds familiar.
By March, the documents are titled Proposed Statement of Balance Sheet Normalization, Principles and Plans, ending balance sheet runoff, and then the ample reserves regime with lower reserves. By April, it's a month ahead of where we are now, but they were reviewing the long run composition of the SOMA portfolio. SOMA is Systems Open Market Account. It's maintained by the Federal Reserve Bank of New York, the most powerful regional Fed branch. And in June, the big discussion items was the setup of a standing fixed rate repo facility for financial institutions to come in and access dollars. And by the end of July, we were in the phase where we were cutting already and announcing by the 1st of April that quantitative tightening had come to an end, pivoting on a dime, rate cuts, QT shifts over to a very lightly paced QE, which then picks up. And then the September call out, I just want to highlight, the documents reviewed were recent tariffs on manufacturing output and the performance of recession probability models. So this is kind of the mode where, 2019 especially, they were on their back foot, or the FOMC was on their back foot from a policymaking standpoint. Their decision making was extremely compressed, is how this reads. They were basically in preparation mode for about 6 months. But when stuff started happening, it started happening very fast. We had issues in the U.S. dollar repo markets, spasming in September and October. They put that out with some liquidity support. We thought we were in good shape November and December, but then by the time the new year rolls around, we had the COVID story really accelerating and springing up as early as the first couple of weeks in January, and things just accelerated from there. This time around, while the discussion topics, it's really a carbon copy framework. Now there's different things this time around. We've migrated from LIBOR to SOFR. These standing fixed rate repo facilities have been implemented, onboarded. I think all of our GSIBs are signed up. These programs should be ready and fully operational for whatever's happening, and as we go into this next phase. But I'd say the takeaway is, all right, 2019, we were having the same discussions, and the Fed was even more reactive and on its back foot, I think, the first time around. Now, this second iteration, the second time at the rodeo, if you will, this is really the FOMC and Fed's chance to demonstrate if they've shored up the U.S. financial system's ability to just handle this part of the cycle. So that's really what we're watching for. Anybody who tells you they know what's next, or how this is going to go down, we don't quite fully know. We do see Treasury rates continue to come in. Yield curve reacted very bullishly with yesterday's policy announcement, in line with the upward trajectory we've seen in Treasuries, going back to at least the beginning of the Trump administration, which really aligns with the with the Treasury under Secretary Bessent that we want to see the Treasury's borrowing rates come in. So everything right now is looking aligned. The key thing is just watching out for any potential ice to slip on.
Matt, is it fair to say though in 2019 the risks were you had similar trade war escalation issues, you had we're going to talk about growth, especially in Europe later. So you're looking at global growth problems or risks. But is it fair to say that there's more uncertainty about inflation this time around? Because I think the narrative in 2019 was inflation still hadn't showed up, right? And now we don't know. Is that, I mean, opinion, but is that fair?
Yeah, that's correct. I would say, yeah. The inflation didn't show up until after the COVID impulse. Like the CPI was just kind of dormant until the second half of 2021. So yeah, they didn't know from a systemic perspective. I'd say in 2019, that cycle, the worry was more biased towards deflation or lower growth and the deflationary scare. I'd say this cycle, after what they saw from 2021 and 2022 with the supply chain problems, price increases, and oh yeah, there was a heck of a lot of new money created with sovereign debt financing, also broad credit creation, and a lot of it absorbed by the Fed. Yeah, that caused price increases as well. So I'd say this time around, the mindset has flipped in terms of where the bias of risk is at that meeting in that room. It's probably skewed more to the concern on impact on rising price levels as opposed to where we were in 2019, where the top of mind coming out of a post 2008 mindset, which was deflation. Like we couldn't actually hit the 2% inflation targets. Is where the mind space was at back then, as opposed to now.
Yeah. Okay.
Makes sense. Okay. Well, so that was our section on FOMC. I think we'll move on now to the next piece, which is on the recently announced EU Savings and Investments Union. So just some backstory here. This was announced on March 18th. You see here Ursula von der Leyen with her tweet here saying, we're going to make investing in Europe easier. It should boost growth, create good jobs, and I've got the little emoji here, but this is essentially my face when I read this as it came across my feed, wondering, okay, they're saying it's going to give their citizens more choice to make the best financial decisions. On the surface, it seems interesting, seems good. Let's dive into it. So I'm going to actually turn this over to Dave. I know, Dave, you've done a bunch of research in the last couple of days, so I'll just turn it over to you. Dave, go for it.
You flip to the next slide. Yeah, I think the problem that they're facing, so the EU is 27 member nations, Eurozone under the central bank is 20. But if you look at the EU as a whole, the way they do saving and investing in retirement, my understanding is pretty structurally different. I think it's culturally different than the United States. But so you look at the tweets, you look at the papers that have been written, and they're saying, okay, we actually want to have citizens of EU countries actually do less sitting in cash in bank accounts and actually do more in investing in things like equities and equity markets, which I think they're probably right. There are structural reasons why that's difficult right now, especially cross-border. So in one sense, they're trying to loosen that up. But what's the actual problem here? We can get into like what they're proposing, but the European Union states, if you contrast it with the United States, they are typically more reliant on social safety nets, and so there's pensions, there's just a standard of just more reliance on the government programs helping you out, and there's less there's less things like equity ownership. So it's almost like you've trained an entire group of people, and these are very different people, obviously, across these nations. You can't say it's not analogous just to the United States, but I think you've trained this region of the world to say, well, I've paid higher tax rates. Most people have some sort of social safety net, pension, something. So they haven't really been trained in the mindset of, hey, you need to plow all your money into equities and maybe bonds in something like a 401k. It's just not the mindset. The issue is that the
No, no,
European Union,
it's not a mindset. And this is where we can start a
but
discussion. I don't know if it's too early for that, but
yeah,
um, it's a framework. It's how
right,
things are set up.
right,
So the EU is really in a world that existed before most of our lifetimes. We're used to a 401k setup where you save for retirement in a defined contribution setup, and you invest that in financial assets, stocks and bonds. Your bank deposits are not really viewed as a savings vehicle. Kind of the wealthier you get, it's just viewed as um, a means of payment, a medium of exchange. You have to have it mainly to pay off debt and settle debts. But the reason the U.S. was unlocked, we talk about big picture trends, why we financialized the U.S. economy really came out of the Revenue Act of 1978, which is where like the 401k comes from. It's a
yeah,
specific code. It's the legal,
ERISA,
it's in
yeah,
that legal code.
yeah,
And that really shifted the unlock of, where the U.S. was in this same situation where the broad majority of the population held their savings, their store of value in bank deposits and home ownership, right? It was really with the 401k, and then technological advancement came in the 90s with online brokerages, things like that have gone now to just, mobile apps where, you can buy a stock while you're waiting in line for your lunch. That, by the way, you can now pay for on installments with buy now, pay later from DoorDash and Klarna. Like what we're really showing here is the degree of financialization of the EU versus the US.
yep,
If the U.S. is indexed on financialization, like on a scale of 0 to 100, they're a 150. The EU is still, they don't even have the groundwork to financialize. Now, you go into like, why do you financialize? Why is it a good thing? You're in a situation where the state requires the allocation of private savings towards its own ends, right? For something, some spending. And it's very clear now that part of that spending, a huge share, is going to be defense, right? If you follow the Ukraine situation closely, it's pretty clear the U.S. wants to make peace. Russia would like to make peace and also keep a lot of the territory that it's taken. Um, it's the EU who wants to keep fighting. So with the part of the walk away and what we've seen in bond markets since the Trump inauguration on January 20th, we've basically seen the U.S. say, no, we're not going to keep footing the bill for this war, this Eurasian war. Um, and if the EU wants to foot the bill, they're free to do so. And the EU is basically saying now they're like, yeah, we're going to do it. And that's where you get into what's going on now in bond markets, FX with, all right, when cost shift, which Trump has been saying since he ran for office in 2015, the rest of the NATO members need to foot their share of the bill. It's finally gotten to that point 10 years later where, the straw has broke the camel's back for the fiscal situation for the U.S. And now we basically have to do it. Like we're pulling back on defense on every kind of front, if you think about it, from the withdrawal from Afghanistan and now the pullback from the Ukraine situation. We're basically cost shifting the defense burden onto EU countries. This is where you see the situation going through now with Germany, saying we're gonna lift the constitutional debt constraints, like stuff like that. And so the fact that now EU is going to have to finance this debt, this deficit spending, where is that going to come from, right? The answer is you've got to unlock private savings. So you do things like what the U.S. did back in 1978 to get out of its own situation, which was really energy driven, free up private capital, encourage mom and pop across Main Street America to buy stocks and bonds in their 401k. That capital now it's kind of levered up and stored in securities, which funds the state capacity for everything that it wants to accomplish. So what this is really doing is it's just channeling private savings into whatever the state wants to do. And to accomplish that, there's a book we're going to go through and do a video series on historical case studies of this. But what effectively you need to do if you're a state to get the purchasing power of your debt claims at par, so the public will fund them, you've got to set up some infrastructure to fund that. So that's what this savings and investment union is all about. It's also signaling kind of this trend, this pullback of what we've seen in U.S. capital markets, with growth coming down, like deficit spending towards defense kind of shifted from the U.S. onto EU member nations. That actually has brought yields in the U.S. as we expect. Well, that solves one key need. And so the U.S. kind of creditworthiness or credit situation improves based on that development. Yields come in means your currency goes down. And then the EU, the domestic capital sitting in EU countries, it sees that growth ahead that those deficits are going to create, and the higher interest rates. And what you're seeing is international capital, think about Paris, Berlin, Rome, everywhere. Those financial advisors or high net worth individuals are selling their U.S. assets, selling their dollars, and pulling them into the EU. And what this is saying, the Savings and Investment Union, if this is the analog to the financialization of the EU, right, which is in terms of capital market sophistication, there's a lot that it's just not at the same bar as where the United States is. Whether that's good or bad, there's trade-offs there. That's up for debate. But this trend, if it is something like that trend we started in 1978 in the United States, this is something that potentially could have a lot of longevity behind this, which could be something that, this isn't something that's a quarter in the making. This could be something that we're talking like a decade or a multi-decade type of trend that we're looking at, which would also tell you to take pause if you're the investor in the United States, the domestic investor, as international capital steps away from the U.S., our home market. Who's going to fill that in? And that's where you get into the question, are these dips, the strategy that's worked the last 40 years in equities and bonds, just buy on dip, buy on dip, buy on dip, and you're only focused on stocks and bonds? This poses a very important consideration, I think, for every kind of U.S.-based wealth manager or advisor or investor to look into and do your due diligence on. This is not something you want to fade or ignore.
So it's being sold. What's interesting about this, Matt, Cameron, if you go back to the first slide, or I don't know who's got control of the deck. The ERISA, the stuff happened in the mid-'70s in the U.S. It's ERISA. We shifted away from defined benefit pensions, where a lot of people had pension plans, and now it's a tiny amount in the U.S. It's only 3%. So it's kind of being packaged up like that. The European Commission. The difference is their demographics are I don't have the chart up here for the 70s here, but they're already aging faster and they're off of an older base already.
Yeah.
So
And when we did this in 1978, Mr. and Mrs. Boomer were, just graduating from
yeah,
college,
yeah,
about to buy a house, buy a car, have 2 to 4 kids. Like the difference in timing here for the
yeah,
EU doing it 50 years later is an important difference for how this backdrop could potentially materialize, whether the
yeah.
policy approach works or uh, does not in terms of achieving its desired outcomes.
And you have to look at how they're selling it too. So yeah, that's 100%. And if you read the paper, this is a marketing. There's a lot of marketing behind this, right? So the sales tactic is going to be, as Matt said, it's the capital markets. They're not, there's cross-border capital markets. They're not super efficient. So they're going to sell it as, hey, we're gonna make regulations simpler. We're going to make sure that these markets are more coordinated, and that's going to give mom and pop investors more access to fund growth and investment in the EU. And what's interesting is that they do call out that um, startups, I'll use the word young, but really any young business, any kind of startup, doesn't have a huge incentive to try to build itself up in Europe and then achieve an exit in Europe. People in the United States almost take it for granted. Is that, oh, I'm going to start a company, I'll own a bunch of the equity, and eventually maybe I can take it public or exit in an IPO. And that's not happening at as high of a rate in Europe. So the sales job, in my opinion, the sales job is basically selling this as, oh no, we're going to make this more vibrant, make it better for startups. We're going to attract because what you want to do is actually bring in young innovators into that area. So that's the sales tactic. But when you go and look at what they're saying it bluntly, but the investment should be for decarbonization and defense. And what is it? The digital transition. I look at those things and say, I'm not sure if those are growth areas or if those are just, as Matt calls out, or those are just things that they on the decarbonization. That's what they want to do. And on the defense side, like they have a gun to their head. They have to do it.
Yeah. So on the decarbonization side, no political opinion given here, but it is, in general, windmill technology from the Middle Ages, basically. Like wind harness energy is less efficient than the hydrocarbon revolution, which has been ongoing since the 1860s. It's just less energy dense, which is not economically productive in comparison to other energy sources. So if you want to focus on that, like you don't get the same economics or productivity gain by focusing on wind or solar. And the EU is not like a solar hotbed besides maybe Italy or the French Riviera, maybe Spain. A lot of it, once you get towards the north, it's not a particular sunny climate. So the organization it juries out because when the U.S. did this, they made this transition, in the 1980s, 90s, et cetera. What were the industries that the capital went towards, right? A lot of it was semiconductor and internet, focused technologies, huge winner. Like we've been on that wave for the global economy, like driving global growth, the internet driven economy since that whole run. So and then you look at like pharmaceuticals, other kind of other similar type of like growth coming from those sectors. Nothing compares to the internet though, that giant wave. It's can you actually channel those private savings into something economically productive? And that remains to be seen. So you went through decarbonization, defense, right? Defense technologies themselves are they are high potential for future economic productivity. Like if you think about like World War II, we start with taking aircraft into the commercial phase. post-war. You could also say cryptography, really made leaps and bounds during World War II. Was the key differentiator, in my opinion, why the Allies won the war. Um, that leads to internet-based communications, those type of things. So defense technologies can lead and have a great track record of leading to like economy-wide productivity gains and economic growth in the decades following. But if it's just going to fund war itself, that it is extremely capital destructive. Like if you're kind of the World War I type of model where you're sending soldiers, munitions, tanks, metal, and you're just gonna send your young men, and now I guess we send women to war too, equal opportunity. Everybody gets a chance. That's extremely capital destructive. So if it's just defense spending to finance another dumb European war, which they've been doing for multiple millennia, that is one path where this doesn't work out well.
Which to state the irony, I guess, is that part of the reason the EU came to be was to decrease the likelihood of war between 27 plus European states.
Well,
so
it's really just it's setting the perimeter. Basically, the EU states unify so they don't fight with each other. But now they're gonna have that same problem: the continent versus Eurasia, which is really, when you say it, like Russia, right? Which has been kind of a key front for since Western civilization encountered the Rus and the other Slavic peoples for all sense and purposes ever. But I wanted to go through just some general charts on what does this look like deposits tied up in your financial system, and how much room does that give you, right? So for U.S. comparison here, top chart, I've got the Fed's H.8 report, which comes out on Wednesdays. I want to say it's biweekly, but they give a snapshot, 2 weeks later, essentially, of what the banking system's balance sheet composition looked like across a variety of just classifications of assets and then different liabilities. And so total balance sheet in the United States banking system is about 24 trillion. It's been slowly growing since basically 2023, but it's back into top line expansion. The white line, and that's the green line. The white line is other time deposit series, which is basically your demand deposits at a bank, which specifically separates out time deposits, like a certificate of deposit, where you've locked up your money for a short amount of time, but it's not readily available on demand for you to withdraw or spend or do something with as a depositor in a bank. So if you look at those two ratios, you'll see post 2008, there's been a massive expansion in bank deposits, and this is kind of what policy wanted to see happen to pop us out of the GFC in 2008. So you saw deposit growth kind of accelerate relative to top line or total assets. And on the asset side of the balance sheet, what does a bank own? Loans, fixed income, other interest-bearing assets, other IOUs. And basically, so you're expanding top line balance sheet. What this is saying is basically the U.S. is in a similar kind of condition coming out of 2008 that the rest of the world has been in, where banks don't want to grow their balance sheets. They do not want to lend into risk. They only want to lend into what they perceive as the safe thing in this environment. The reason for that is if you're a bank executive and you're in charge of making these decisions, like who you lend out to, how much you want to grow your balance sheet, et cetera, how much risk you want to take, you've seen so many things over the last 15 years, starting with Bear Stearns going out, Lehman, your friends at Washington Mutual, Silicon Valley Bank. And this is like a normal occurrence in the banking industry. Like risk is, it's a highly levered system. Risk happens, right? But in this specific period, it's very clear at the top level. This is not actually the type of environment where you want to be aggressive in your risk. Like maybe not from quarter to quarter or year to year, but looking at the whole thing. You want to drive the car pretty prudently because, like when we get into these points when the system is on the other side, the wind down of a credit cycle, things get risky, and that's when you get taken out. So by and large, your executives want to be very defensive, and that kind of lines up with the deposit creation that's coming. The banks don't expand the rest of their balance sheet. What does that mean? Certain projects in the economy that don't meet the hurdle rate for risk have a tougher time getting capital. This is not just an EU situation. This is in the U.S. as well and other global markets. So how do we deal with that in the U.S.? This is where, so from the tops down approach, we have kind of made the choice as a society, as a banking system itself, like the U.S. just culturally is not doesn't have it in its DNA to be fully state run, and a bureaucrat in Washington D.C. tells the banking system exactly what you're going to buy. Now it can happen during times of war, right? Where say World War II, U.S. Treasury said to the Fed, basically they're like, you're going to finance this, you're going to buy things at 3, or you're going to buy all the debt at 3 or below, keep interest rates pegged, etc. It can happen for war, but for telling capital who's going to get what and why. Some administrations have tried to push the line there, but culturally we just don't go for it in America. So what we do instead is we, more so than other countries, we let markets listen, and we let private investors decide who's going to fill that gap. So this is where you see, like, post 2008, the rise of private capital, where say banks don't have the risk tolerance to fund credit creation from their balance sheets or equity financing from their balance sheets. We see the kind of the growth and increasing stature of private shops, if you will, who fund into risk. So certain groups might focus on real estate, certain groups might focus on mid-sized industrial businesses in the Rust Belt. Some might focus on, venture projects out in Silicon Valley. Some might be focused on more of a credit angle and providing, private credit financing across the board to these portfolio companies from their peers in the private space. But in the U.S., the trend has been made like we're not going to tell the banking system what to do or the public what to do. We're going to let the households, businesses, and private capital decide who they want to deploy capital to, which is, in my perspective, a much more economically efficient way to do it and has a much higher probability of leading to better outcomes when you let human action decide what gets investment capital and where society's resources get allocated. So keep on in mind, we've cranked up the deposits to total assets percentage since 2008. It's up to 65% now, which may be pushing the limits. We'll see if this is hard cap of how heavy we can make a financial system reliant on deposit-based financing. Maybe that COVID kind of spike up to about 75%. We'll only know in hindsight whether that was the peak of how hard we could push that throttle. So we'll know that. But to juxtapose that with the EU, I couldn't find the time series of these figures in time, but the EU publishes the MIFS reports, which give those same figures. I just don't have them in time series form. But as of their most recent print this March, this is kind of the composition of their financial system on an aggregate basis. So about 35.95 trillion, call it 36 trillion euro of assets on its collective balance sheets. And from a depositor standpoint, there's 16.18 trillion, call it, in euro deposits sitting in its banking system. That's really close to the amount of dollars sitting in the deposits in the U.S. banking system for its domestic economy. So very close, apples to apples, different currency though, dollar versus euro. But if you look at that deposits divided by total assets, it's about 45% in the EU. So there's already a lot more balance sheet expansion on top of that deposit base in the EU than exists in the US. Now, how much actual capital is there in the EU system? It's levered about 10.7 to 1, which is roughly similar to where the U.S. banking system sits right about now, about 10.2, something like that is the latest number I have. So from that standpoint, if the goal of the EU is to drive capital into credit and equity investments, like just loosen up that deposit-based funding where banks aren't by themselves doing it well, like doing the job like to an adequate degree that Ursula von der Leyen and her peers in Brussels say they want. That's that number there, that 45% that they potentially want to drive up. But then on top of it, it's that whole securities kind of aggregate that would be levered on top of that. Like you have the same amount of deposits in the system. It's just who gets those deposits. It's going to be funneled into equity and fixed income securities is the idea inside those same depositors' 401k. So really what you're seeing conducted here is kind of just financial leverage applied to the EU economy. And I think the goal is to see something like the big unlock or what happened in the U.S. from 1980 to maybe call it 2008, because whatever happened from 2008 to 2020, maybe you don't need to replicate that if you're the EU. But what you're looking to see is kind of that 1980s and 1990s type of growth hitting the EU economy that would be coming from just bigger 401ks, more stocks and bond asset values leveraged on top of that deposit base. And the hope is that by doing that, you'll unlock, or you'll basically get the European economy out of this kind of lull that it's been in for, you can go on for a while, basically like post-World War II. It's kind of not kept up with the U.S. and Asian growth. So that's kind of the objective of what the EU is trying to accomplish here.
And to add to that, I think this last slide that you plugged in here, I saw this and I laughed and I thought to myself, this is exactly, I think, what a lot of those folks over at the EU are thinking, or ECB are thinking, where they're putting this out, and I think it's really telling that throughout all of these, just FYI, I think there's 5 or 6 different fact sheets and PDFs, glossy images and things that they put out as marketing, like you're talking about. But throughout all of them, it's talking about Europe needs to unify, right? So there's fragmentation across each of the different underlying states. We all need to come together and understand that having a singular, I think they push for a singular risk-free asset as an example, and several other types of attempts to push all these fragmented states together. And it really, this slide, I think, is the exact epitome of that.
This is the European Commission is the sort of the technocratic arm, and they're the ones who are going to propose this. It needs to be approved, but then they enforce it. And so yeah, it's, I mean, there's a union, but this is an executive / technocratic solution to a problem that they see that's unfolding. Then it's going to need to be approved, and then it's going to then there'll be the commission's the one that's going to enforce it. So yeah, it's the I guess the join part is going to come at the vote. So I don't know. I don't know what that looks like in terms of debate, but we'll see.
No, this literally is the approach. What's going on in the EU? They are trying to consolidate. I do think they view this as existential. Maybe, I mean, it shows up everywhere to the point where they'll listen to a 15-year-old girl who claims the sky is calling or falling to set, industrial policy, energy policy, et cetera. But it really is, I think, that sense of existentialism going on in the EU. And from the Brussels standpoint, it really is like it's what Mario Draghi said back in 2011, 2012. It's like we'll do whatever it takes. And this is like U.S. pulled back. They said, okay, whatever. We're going to keep going. We're going to keep fighting because they view this as like truly whatever it takes. And we'll see how it goes. It does, just joining and centralizing as kind of this savings and investment union is kind of the next step to unfold in that process, where now you've got more encirclement and consolidation of its own private citizens' capital, and concentrated and focusing on what the state wants to accomplish. Doesn't necessarily mean you're going to get the same results and growth that say the United States had out of this project. That's been going great for 250 years, give or take, with our own hiccups along the way. But maybe if you do it well, it could go that route, or it could go. The USSR was another example of another group of disparate cultures, societies, economies that consolidated and was not built on the right foundation or DNA. So time will tell. They're going to continue. The EU is going to continue to consolidate. It will attract capital through this process, and what we've seen in Q1, I think, likely carries through over coming years. This isn't just a passing quarter from my perspective. But the long-term results measured in decades or lifetimes are kind of something that it's wait and see. But your underlying plan has to be sound before that happens. And I don't know that we have the EU has the same cultural DNA. They obviously don't compared to the U.S. on a lot of fronts. So this one's continued work in progress. But this kind of continental dream that's been underway our entire lifetimes just continues into its next step. It's hit the financial system angle as far as banking and savings, and ultimately into increased financialization in its economy.
Well, any final thoughts, Dave or Matt, before we wrap today's episode up?
No, let's keep an eye on this one. I think as it goes through, it's got to get voted on. Let's just keep an eye on and come back to it. I think this is a big one. So yeah, good work, Matt. This is interesting stuff.
Yeah, I think we're closing the door on Q1. I think we've got maybe 6 more trading days. The volatility, the sell-off that really got under the way, especially hitting the Mag 7s. All tech capital, essentially, like ASML in the Netherlands, another example, TSM in Taiwan. All tech has been sold off. It was really just kind of a market beta and capital allocation that drove what we've seen in Q1 from my perspective. It's really interest rate driven, FX driven story, and where capital flows want to go. Q2, I think we maybe shift scene into something where whatever it is we're headed into with the debt ceiling resolution coming in August, September, those negotiations are going to start happening fast and heavy in the United States as we work towards improving the fiscal situation in line with where the best administrator or best treasury department would like to see things develop from our own deficit standpoint. So that's domestic, where you heat up, and then on the geopolitical front, we'll just continue to watch and see what happens in Ukraine, what happens in Israel and Gaza. But probably not a smooth sailing type of low volatility story. I'd expect volatility to continue throughout this year. So we'll just continue to wait and see. But those core trends we saw in Q1, look for those to carry through and continue to drive action over the course of or as we move into the second quarter of 2025.
Great. Well, thanks everyone for watching. Don't forget, again, we're streaming this from our new Build Markets X account. If you've got friends who maybe follow Levered USTs, Matt Dines over here, have them also follow our account. We'll also be posting these videos up on YouTube and LinkedIn as well if you have accounts there. So thanks everyone, and